Hi, today we're going to talk about demand analysis as part of microeconomics. So, law of demand states that quantity demanded typically increases at lower price. So, we have this diagram here where the quantity demanded is on x-axis and prices are on y-axis. Demand curve is downward sloping. So, as price goes down from P1 to P2, the quantity demand increase from Q1 to Q2. Price elasticity of demand is the percentage change in quantity of demand to the percentage change in price. This is the formula. So you may think is price elasticity is a slope of this demand curve, which is actually not. Price elasticity do change at various price levels. So it's more elastic for the goods which are more expensive, which have higher price, and the demand is less elastic for goods which are cheaper. And it's kind of intuitive. Goods which are expensive, their consumption can be stopped, or it can be moved to less expensive good easily. So there are various factors which affects the elasticity of demand. First one is close substitute availability. If there are close substitute available, if the price of the main good increases, then the consumer can move to the substitute product. So it's a well understood. Portion of income spent on the goods. So the costly the goods are, their demand is more elastic. So we just talked about it. Time. So in short run, demand is inelastic. In long run, demand is more elastic because it's easier to shift to other goods in the long run. And how important the good is. So the goods which are less important and which are not very valuable from individual perspective, they have more elastic, more elastic demand. So we have talked about the own elasticity of demand. Now we're focusing our attention to income elasticity of demand. Income elasticity of demand is price change in quantity demanded to the percentage change in income. And here we're talking about three types of goods. First one is normal goods. Now for normal goods, as the income level increases, their demand increases. Uh, uh, for example, furniture, uh, demand for meat, for food. Inferior good, like as the income increases, leads to decrease in quantity demanded. For example, we can take example of bread. When Even though it's when people making more money, their consumption, they may start eating more expensive food items, more meat items than just eating bread. So this is one of the example for inferior goods. For valuable goods, high prices of those goods make them more desirable to customer. For example, expensive car or luxurious bags. So in those cases, they have upward sloping demand curve because as their price increases, they become more valuable, and people who have higher income, they want to buy more of these goods. Cross elasticity of demand is the rate of change in quantity demanded of a good to the percentage change in the price of a related goods. So these related goods could be substitute to each other. So if the price of a main good goes higher, their substitute becomes more valuable because their price is still less, and so a customer, they start consuming more those substitute goods. If the goods are complementary, so for example, pen and ink, in this case, if a price of ink goes higher, the demand of pen will go down. People may move to other other substitutes in those cases, like pencil, they may start using. That's just an example. So overall, the price elasticity of demand is more positive the better substitute two goods are, and more negative, the better complement two goods are. So it's quite intuitive. Here we have an example of a substitution and income effect of on inferior products. So in this graph you can see we have this BC1 demand curve, which is downward sloping, and E1, it shows the current level of income curve. So as earlier, the 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 price was x1 and the quantity demanded was y1 for that good, and the equilibrium was at point A. As due to substitution effect, this could became cheaper in compared to the other goods. So the quantity demand increased uh, from y1 to ys in this case, and the price, it came down to x1 to xs. And so this represents the substitution, a positive substitution effect. So as we know, in case of inferior goods, as income level goes up, their demand goes down. So in this case, this I2 curve represent the higher income level. So so this is to represent the income effect. As income went up, the demand went from ys to y2, and at a new equilibrium level, which is C. Uh, so price it has changed. It's changed to x2. So this is to show the substitution effect, which is from y1 to ys, and the substitution effect from ys to y2. Thank you.